The update today is important and it deserves clear and careful attention. There has been a growing wave of information circulating about stimulus payments connected to the IRS, with many reports pointing to January 26th as a key date. For many seniors, retirees, and households on fixed incomes, hearing the words stimulus payment immediately raises hope, concern, and a need for certainty. This conversation is not about excitement or fear. It is about understanding what is actually happening, what is officially acknowledged, how eligibility works, and how this information connects to Social Security, SSI, SSDI, VA benefits, and retirement income. The goal is to help people feel informed and steady, not confused or rushed. Over the past several weeks, government agencies have been dealing with a complex mix of tax adjustments, benefit reviews, and administrative corrections. When the IRS becomes part of these discussions, it usually signals activity tied to tax records, income reporting, or payment processing systems. In this case, the focus is on payments that are being described as stimulus-related, even though they do not resemble the large emergency checks issued during the height of the pandemic. That distinction matters, especially for seniors who remember earlier stimulus programs and may assume the structure is the same. These payments are different in purpose, timing, and eligibility, and understanding those differences protects people from false assumptions. January 26 is being referenced because it aligns with a processing window when the IRS begins releasing certain types of payments connected to prior year tax adjustments, refundable credits, and reconciled benefit calculations. For seniors, this is particularly relevant because many older Americans either do not file taxes at all or file simplified returns that rely heavily on Social Security income. When the IRS processes adjustments, it does not always label them in a way that is immediately clear to recipients. A payment may appear as a deposit or check without the word stimulus attached, even though media headlines use that language to simplify the story. It is essential to understand that the IRS does not create new stimulus programs on its own. Any broad stimulus initiative must be authorized through legislation, and no brand new universal stimulus law has been passed promising automatic checks for every American on January 26th. What is happening instead involves targeted payments tied to existing authority. These include corrections for missed credits, delayed refunds, recalculated tax benefits, and payments owed to individuals whose information was updated or corrected after earlier processing cycles. Seniors are often included in these groups because of changes in filing status, income thresholds, or benefit reporting. Many older adults rely primarily on Social Security retirement benefits, SSI, SSDI, or VA compensation. These programs operate independently from the IRS, but they intersect through income reporting. When income records change or when a credit applies retroactively, the IRS becomes responsible for issuing the payment. That is why some people receiving Social Security are seeing IRS-related deposits rather than payments coming directly from the Social Security Administration. This does not mean Social Security benefits are changing, stopping, or being replaced. It means the IRS is settling accounts connected to tax law. Eligibility for these payments is not universal, and it is not based solely on age. Eligibility depends on factors such as whether a person filed a tax return, whether they qualified for certain refundable credits, whether there were errors or delays in previous processing, and whether income fell within specific thresholds during the relevant tax year. Seniors with low to moderate income are often eligible for refundable credits even if they owed no taxes, which is why payments may still be issued to people who believe they do not interact with the IRS at all. One important point for older adults to understand is that these payments are not loans and they are not advances that must be paid back later. They are reconciled amounts that the IRS determines were owed based on existing law. When a payment is issued, it reflects a conclusion that the recipient met the criteria at the time being reviewed. This provides reassurance, especially for seniors who worry about unexpected obligations or future clawbacks. While errors can happen, the system is designed to avoid issuing money without legal justification. The connection between these IRS payments and Social Security often creates confusion. Some people assume that receiving an IRS payment means their Social Security benefits will be reduced or affected. That is not how the system works. Social Security payments are calculated separately and are not lowered because of IRS-issued refunds or credits. In most cases, these payments do not count as earned income and do not interfere with retirement benefits. For SSI recipients, the rules are more sensitive, but even there, retroactive tax credits are generally treated differently than regular income. Understanding this distinction helps prevent unnecessary worry. Another reason January 26 has gained attention is timing. The IRS operates on large batch processing schedules. When a batch opens, thousands or even millions of payments can be released within a short period. Some people will see deposits earlier, some later, and some will receive paper checks instead of direct deposits. This variation does not indicate approval or denial. It simply reflects how records are processed. Seniors who do not use direct deposit may experience longer wait times, which is normal and not a sign of a problem. There has also been discussion around fixed income households and inflation-related relief. While inflation relief has been addressed through cost of living adjustments to Social Security, it has not been handled through new stimulus checks in the traditional sense. The IRS-related payments being discussed are not inflation bonuses or monthly supplements. They are one-time reconciliations tied to tax law. That distinction matters because it prevents false expectations of ongoing payments. For retirees who worked part-time, withdrew retirement funds, or experienced changes in income during the year being reviewed, eligibility can shift unexpectedly. A person who believed they earned too much to qualify for a credit may later discover that deductions, adjustments, or updated calculations place them within eligibility limits. The IRS system catches these situations during reconciliation phases, which is why payments sometimes arrive months after the tax year ends. It is also important to address the emotional side of this topic. Many seniors live on carefully planned budgets. Any unexpected deposit can feel both relieving and unsettling. There is relief because extra money helps with groceries, utilities, and medical expenses. There is also concern because unexpected payments raise fears of mistakes or scams. That is why understanding the official process is so important. IRS-issued payments come through recognized channels and are backed by recorded determinations, even if the explanation arrives later by mail. Scammers often take advantage of moments like this by spreading exaggerated claims or false deadlines. They may use phrases like final chance or last call to pressure people into sharing personal information. The reality is that legitimate IRS payments do not require phone calls, signups, or fees. Seniors should never feel rushed or pressured to act in response to news headlines. Official processes move on their own timelines and do not depend on individual outreach. As this situation develops, clarity remains the most valuable tool. Understanding that January 26th represents a processing window rather than a universal payout date helps ground expectations. Understanding that eligibility is based on prior records rather than new applications helps reduce anxiety. And understanding that these payments are separate from monthly benefits helps seniors maintain confidence in their financial stability. This conversation is not about promising money or creating urgency. It is about making sense of information that is already affecting people. When a deposit arrives or when a notice is received, seniors deserve to know why it happened and what it means. Knowledge replaces fear and understanding replaces speculation. In the next part, the focus will move deeper into how eligibility is determined, how different benefit recipients are affected, and what practical steps seniors can take to stay informed without stress. The goal remains the same: clear information, steady guidance, and respect for the realities of living on a fixed income. Understanding eligibility is one of the most important parts of this entire update because eligibility is where confusion usually begins. Many people hear the phrase stimulus payment and assume it applies to everyone equally. In reality, eligibility is determined quietly through records that already exist. There is no open enrollment, no new form to request money, and no special action required to trigger these payments. The IRS reviews prior tax information, benefit data, and reported income to determine who qualifies. This means eligibility is passive, not active. Payments are issued because a person already met the criteria, not because they asked for it. For seniors who file tax returns, eligibility often relates to refundable tax credits. Refundable credits are unique because they can result in a payment even when no taxes were owed. Many older adults qualify for these credits due to modest income levels, retirement status, or a combination of Social Security income and limited additional earnings. When a refundable credit is recalculated or corrected, the IRS may issue the difference as a payment. This can happen months after the original filing, especially if records were updated or verified later. Some seniors do not file tax returns because their income falls below the filing threshold. This does not automatically disqualify them. In past years, the IRS has used non-filer information, benefit records, and prior filings to determine eligibility. When data systems are updated or reconciled, payments may still be issued to non-filers if the law allows it. That is why some retirees who have not filed taxes in years still report receiving IRS payments. These payments are tied to eligibility rules, not filing frequency. Social Security retirement beneficiaries often wonder whether their monthly benefit amount affects eligibility. Social Security income alone does not disqualify someone from receiving IRS-issued credits or adjustments. What matters is how total income was classified during the relevant tax year. For many seniors, Social Security benefits are partially or fully excluded from taxable income, depending on overall earnings. When calculations are revised, eligibility outcomes can change, leading to payments that were not originally expected. SSI recipients face slightly different rules, but the key point remains that IRS payments tied to tax credits are not the same as wages or ongoing income. These payments are generally treated as retroactive or corrective in nature. This distinction matters because SSI has strict income and asset rules. In most cases, one-time IRS payments do not permanently affect SSI eligibility, though timing and reporting rules can matter. The important takeaway is that receiving an IRS payment does not automatically mean SSI benefits are in danger. SSDI recipients often fall into a similar category as Social Security retirees when it comes to tax-related payments. SSDI benefits are based on disability status, not income level alone. IRS-issued payments tied to tax adjustments do not change disability determinations. For many SSDI recipients, income remains low enough that refundable credits still apply. When the IRS corrects or finalizes those credits, payments are issued without affecting monthly disability benefits. Veterans receiving VA benefits frequently ask whether IRS payments interfere with their compensation or pensions. VA benefits are not taxable in most cases, and they are not reduced because of IRS refunds or credits. The IRS and the Department of Veterans Affairs operate under separate systems. A veteran receiving a tax-related payment from the IRS is not signaling a change in VA status. These payments exist alongside VA benefits, not in place of them. Another area that creates uncertainty is the method of payment. Some seniors receive direct deposits while others receive paper checks. The method depends on what information the IRS has on file. Direct deposits are usually faster, but paper checks are still common among older adults who do not use electronic banking. A delay in receiving a check does not mean eligibility is in question. It simply reflects the time required for printing, mailing, and delivery. It is also important to understand that payment descriptions may vary. Bank statements may show generic descriptions that do not clearly say stimulus. This can lead to confusion or suspicion. The IRS often uses internal codes or brief labels that are not designed for public clarity. Seniors should not panic if the description is unfamiliar. These labels are part of internal accounting systems, not indicators of legitimacy or illegitimacy. There has been discussion about income limits and how they apply. Income limits are based on the tax year being reviewed, not current income. A senior who recently experienced a change in income may still qualify based on earlier records. Conversely, someone who had higher income during the reviewed year may not qualify even if their current income is lower. This timing difference explains why neighbors, friends, or spouses may have different outcomes even when their current situations appear similar. Marital status can also affect eligibility. Married couples who file jointly are evaluated together, while those who file separately are evaluated individually. Widows and widowers sometimes receive payments tied to earlier joint filings or adjustments. These situations can feel confusing, but they are part of how the system reconciles past records. Payments are not random. They follow documented filing history. For seniors who worked part-time, withdrew from retirement accounts, or sold assets during the reviewed year, eligibility calculations can be complex. Even small changes in reported income can affect credit eligibility. The IRS uses automated systems to process these calculations, and when discrepancies are resolved, payments may follow. This is one reason why payments can appear long after a tax year has ended. Another point that deserves attention is taxation. IRS-issued payments tied to refundable credits are generally not considered taxable income in the year they are received. This means seniors do not usually owe taxes on these payments. That provides reassurance for those who worry about unexpected tax bills. While individual circumstances can vary, the overall structure is designed to provide relief, not create new obligations. There is also concern about whether these payments affect other assistance programs such as SNAP, housing assistance, or Medicaid. In many cases, one-time tax-related payments are excluded from income calculations for a certain period. This prevents temporary relief from causing long-term harm. Seniors who rely on multiple programs should know that the system recognizes the difference between ongoing income and corrective payments. The emotional impact of financial uncertainty should not be underestimated. Many seniors have lived through decades of economic change and learned to be cautious. Hearing about IRS payments can reopen memories of audits, penalties, or complicated paperwork. That is why clarity matters. These payments are administrative outcomes, not enforcement actions. They represent completion, not scrutiny. As January 26th approaches and passes, more people will share their experiences. Some will receive payments, others will not. That difference does not mean one person did something right and another did something wrong. It reflects how eligibility criteria applied to individual records. Comparing outcomes can lead to unnecessary stress, especially when situations differ in subtle but important ways. The most important thing for seniors is to stay grounded in facts rather than headlines. Headlines are designed to attract attention, not provide full explanations. Understanding that these payments are rooted in existing law and past records helps replace speculation with confidence. Seniors deserve stability, not surprises.